Tax on profit is not going to stop people investing in an asset class where you can leverage, $100,000 into $1 million asset.
Yeah.
I'm sorry. It's that math just doesn't stack up. Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today, why capital gains tax is a good thing for New Zealand.
We're back in your life, and we've got an extra spicy one for you today. Mike, we've got an opinion piece on capital gains tax.
Yeah.
And, we've had David Seymour on the show. We have very...
famously pro-capital gains tax.
Yeah, we've got some very pro-property views, pro-wealth creation.
Yeah.
It might surprise people that we think a capital gains tax is potentially a good thing for New Zealand.
Yeah. Now, this is going to divide a lot of opinion, but effectively, a capital gains tax is a tax where you are taxing the realized capital gain on an asset. Now, some people get that confused where in some instances around the world, they are proposing to tax unrealized capital gains on assets. So house increases from $1 million to $1.1 million per year. You might be paying, say 10% tax on that unrealized capital gain. You haven't sold the house. That is not what we're talking about here.
That would probably be a wealth tax, right?
Yeah.
Which I think the Green Party does tend to come out with each election and then goes absolutely nowhere. I think the first piece around, there's just a gap in is essentially the best way to describe it, is if you earn an income, you pay a tax, and with the capital gain, you don't pay a tax. And then that means that for a lot of people, they start funneling money into assets and kind of rigs the system a little bit, right?
Yeah, and complexity creates the opportunity to not avoid tax, but pay less tax, right? And the people who can afford complexity or have complexity and have accountants are generally the wealthy. So they end up paying less tax. And the extreme version of this is if you look in the States where, say, some of the big tech billionaires don't actually pay themselves a salary. They borrow money at effectively 0% against the value of their company, spend that, and end up paying no tax whatsoever. So that's the extreme version. Again, that is not what we're talking about here. What we're talking about is if the value of your asset goes up and you realize that value, you should pay tax on that. Now, some people argue that actually, we kind of already have a capital gains tax in the form of our bright line tax with property. That is a tax that's really there to stop people flipping property and using property flipping as an income without getting any tax on it.
Yeah, and old mate Winnie in 2018,
I think it was 1920, wasn't it? When
had the chance to put this all to bed.
Yeah.
And the other thing that happened, opposed to just putting in a capital gains tax, was we made this stupid, super complicated system where we had removed non-interest deductibility on investment property, which does not make sense at all because it's an expense of business. We had two classes of property between new builds and existing properties, and just mucked around with this whole thing, which made it way more complicated than just going capital gains tax. Yeah.
Now, you will often hear reasons why it's not a good thing. Some of the reasons why we think it is a good thing, and I mean the real kind of driver for this for me and why I think a capital gains tax is a good thing is actually not because of the fairness issue between, households that aren't paying tax and are paying tax. It's not because, it creates asset classes that are more attractive because they're not taxed properly. It's because it will drive investors into putting their capital into productive assets. Now, what I mean by that is, at the moment, we've got what is effectively quite a large unproductive asset, right? Housing, property, land, it doesn't really employ a lot of people. Yes, it provides housing you can provide accommodation for people who can't buy, but it is not productive for the New Zealand economy on the whole, right? It is just a store of value and it's not taxed at the same way that other more productive assets are. And it would be about using tax to drive investment towards more productive assets.
And my big thing as well is if you look at the OECD and kind of all of the countries we like to compare ourselves to, we're definitely an outlier, right? And some countries have far more tax than we do as well, outside of just the capital gains tax.
Yeah.
So I think it's kind of bringing us back in line with Australia and the UK and all these other countries. to go, it's kind of weird that we don't have it. And once again, like, comparing to a place like Australia, there's also things like stamp duty as well that we don't have to worry about. Granted, for those that understand Australian tax law, which would do much better than I do, there is also like some other benefits that we don't have.
Yeah, the offsetting stuff with their, the offsetting their losses on their investment portfolio against their PAYE income or their salaried income is just absolutely wild. I don't know how they can still do that.
Just put yourself in the LLC, deduct your income, declare yourself employed. It's all great. So that's why I think a capital gains tax is just tidier. There's other things you can do.
I think it's coming anyway.
Sense.
Eventually it will come. And we often get asked by people, would you still be doing the same investment, decisions because the capital gains tax is coming down the road? Like, well, yeah, I can't change that. It makes no difference to me.
Yeah. And essentially what we're going is, if property in particular gets taxed when you sell it, then you go, okay, well, you are going to be paying X percentage tax on the sale, but you get to keep all of the gains outside of that tax. And some people are focused so much on minimizing their tax that they forget that they get to keep the large majority of the capital. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. Now, we're not saying there won't be any challenges, costs, ramifications, or anything. There will be winners and there will be losers out of this, And I think the big one is really, it's going to be that mindset around the cost for individuals of, I'm going to have to pay tax on the sale of my home, right? And my parents didn't do it. I've never had to do it previously. Why should I have to do it now? And, there will probably be ways that the government ease that in, i.e. there probably won't be any capital gains tax to start with on the sale of your owner-occupied property. But I think that that's going to be the biggest headache, is getting people's head around it.
Yeah, I think highly unlikely that you'd have a tax on a owner-occupied. But I do agree, like, people go, well, it's hardest time ever to try and get ahead in comparison to other generations. The other one I worry about is New Zealand is getting the least amount of investment overseas of any OECD country at the moment. And that is a big concern right now, that we've just got to go, yes, capital gains tax is one thing, but I don't think you have to do it in isolation. I think you have to look at kind of all the tools you've got, not just in that, but as an economy, and go, how do we make it more attractive to do business in New Zealand? Because fundamentally, it's quite simple. We want more money in here. We want it going around. We want people feeling confident. Like it's pretty much as simple as that. And we, was it Winston Churchill's who said, taxing yourself is like standing in a bucket and trying to pull yourself up. We just got to be careful about that part. So I don't think it's, you look at it in isolation, you kind of look at it and then go, what are the other things we can do? Yeah,
I mean, I completely agree, right? And what we want is, we don't want investors taking fewer risks in New Zealand because of the tax implications. Now, people, when we're having these discussions, often take these to the extremes, right? And say like, well, if we introduce this tax, everyone's going to bugger off to Australia, or no one's going to do this. Well, yeah, that's not really how it works. And I don't like it when people have those sorts of arguments and don't actually have a constructive discussion about it. And, for example, you can take the movie industry, right? The movie industry in New Zealand, yep, we give them a lot of tax breaks. Yep, we are effectively competing against some of the larger kind of players in the industry, LA and elsewhere where they make movies. But they are still taxed when they make movies in New Zealand. And if you ask, someone who has a vested interest in it, i.e. Peter Jackson, he would say, no, don't tax it. No, they should be effectively tax-free, get all the tax rebates. It's, $1 that they spend goes around in the economy. If you ask someone at the other end of the spectrum, maybe the Green Party, who are saying, tax the absolute hell out of them, you'll get two very different opinions, but both people have a vested interest, and that is why they have that opinion. What we're saying is, it's not reducto ad absurdum. Don't take it to the extreme. Look at it down the middle and go, a capital gains tax will be a productive tax for the country.
Yeah, and hopefully the money is used well and we can go build some hospitals and schools, opposed to, tell you what, the amount of cones around my property right now is just, how much as a country are we spending on traffic cones? I don't know, but let's move on for that. So quite a bit to think about there. I think the only other point that I'd like to raise is just also the risk around if property investors decide in their droves to not invest, that leaves a huge problem in terms of where are all these people going to live, because the government can't find housing for all these people.
Yeah, property investors, just because of a capital gains tax, will not stop investing in property. I can absolutely guarantee you of that. And again, like we talked about before, overseas, you've got stamp duty and this tax and this tax. Tax on profit is not going to stop people investing in an asset class where you can leverage, $100,000 into $1 million asset.
Yeah.
I'm sorry. It's that math just doesn't stack up.
And just remember, if you make $1 million and you pay 30% tax, you still keep $700,000. So we're going to wrap it up there. I know this one is a highly controversial one. So comment section, please come for us. Much love to Partners Life for sponsoring this episode. Please subscribe to the channel, give us a review, give us a like. We'll catch you next time.
Cheers.